Hello and welcome everyone. Today we're going to dig deep into an explosive development in the U.S. economy where Austan Goolsbee, the president of the Chicago Federal Reserve, has dropped a bombshell by stating that interest rates need to be slashed by a lot over the next year. Now, I'm sure you're all wondering why the Federal Reserve is considering cutting rates so aggressively, especially after a series of increases over the past few years aimed at taming inflation. Is this rush to lower rates a life vest for an economy that's quietly sinking? Or is it a carefully calculated move, as Goolsbee suggests, to stop unemployment from spiraling out of control? Spoiler alert, it might be both. But there are larger issues beneath the surface, and today we're going to peel back the layers of what's really going on. Let's dissect it all. From the jobs market and inflation to why an economic recession could still be lurking around the corner, despite some voices trying to say the worst is behind us. Let's jump right in. So what exactly did Mr. Goolsbee say? Well, he made headlines during an interview with WBEZ, a public radio station in Chicago, where he claimed that interest rates need to come down significantly, by a lot, as he put it, over the next 12 months. This statement comes after recent actions by the Federal Reserve to lower rates by 50 basis points during their last meeting, marking the central bank's first rate cut since the pandemic-driven rate slashes of 2020. Right now, the Fed funds rate sits in the vicinity of 5 to 5.25%, a level that many officials agreed was necessary to help curb inflation. But it seems, just as inflation is finally decelerating, Goolsbee is signaling a pivot, a shift away from the Fed's singular focus on controlling prices toward addressing a new concern, the jobs market. Goolsbee's rationale for these cuts is rooted in the labor market. He emphasized that the unemployment rate, currently sitting around 4.2%, needs to be kept from rising further. Now, here's where things get interesting. The traditional relationship between inflation and unemployment, known as the Phillips curve, has been notoriously finicky. Remember the past years of ultra-low unemployment but moderate inflation, or the recent high inflation with record-low unemployment? These trends have blurred the lines Fed economists usually rely on to make decisions. Furthermore, Goolsbee notes that inflation has come down substantially and is now flirting with the Fed's 2% target. This has given him, and presumably the rest of the Fed, a bit more wiggle room to start focusing on the job market. Slowing job growth, stubborn unemployment, and the looming threat of supply chain disruptions triggered by worker strikes, like those from U.S. dock workers, make saving the labor market imperative. Now, let's pause and ask a key question. Is inflation down enough to warrant such aggressive rate cuts? Sure, inflation has cooled, with the Consumer Price Index, CPI, inching closer to the Fed's 2% target. But when you look at some key sectors, you start to see a very different picture. Look at rents and housing. Yes, the housing market isn't on fire like it was in 2021 or early 2022, but rents are still high in most major metropolitan areas. According to recent data from Realtor.com, median rental prices are still hovering almost 25% higher compared to where they were pre-pandemic. Rents and housing are a massive component of the total inflation basket, so while overall inflation might look like it's tapering off, millions of Americans are still feeling the pinch where it hurts most: shelter. Next, let's look at food and energy costs. Gas prices might be down from their highs, but they're far from cheap. In fact, crude oil prices broke $90 a barrel in September 2023. Is anyone seriously expecting transportation costs to stabilize in this energy market? We can't forget energy feeds into just about everything: grocery costs, factory production, transportation networks, all of it. And then there's food inflation, with prices up around 5.3% year over year, according to the U.S. Department of Agriculture's September 2023 estimate. Even if headline inflation drops to that golden 2%, the reality for average households looks quite different. The situation here is complex. While macroeconomic data might suggest inflation is easing, many essential everyday goods remain elevated, which continues to weigh on consumer spending power. Now, let's move into the other reason Goolsbee is waving the alarm flag: the slowing labor market. The U.S. unemployment rate at around 4.2% is higher than it's been over the last 2 years, but it's still reasonably low by historical standards. So what's the problem? Here's the rub. It's possible that we're starting to see what economists call structural unemployment creep into the system. In the earlier stage of the post-pandemic recovery, we talked about how jobs came roaring back and unemployment dropped rapidly. But a lot of those gains were concentrated in low-wage service sectors, retail, hospitality, food services, gig economy work, jobs that, let's be real, don't pay much and have little stability. Sure, unemployment dips when people fill these positions, but it's not exactly a sign of a healthy, sustained middle-class labor market. Take into account strikes by dock workers or employees from companies like Starbucks or UPS, who are fighting for better pay and conditions, and you begin to see that the labor market isn't humming along as smoothly as policymakers would have you believe. Add to that geographically uneven recovery. Cities like San Francisco, Chicago, New York, they're still grappling with the ramifications of tech layoffs and businesses restructuring after the pandemic. According to McKinsey's 2023 Future of Work report, a whopping 20% of U.S. workers may need to switch occupations by 2030 due to automation and AI, and those job losses won't be evenly distributed across the nation. The Rust Belt and some Midwestern cities might struggle to find new, high-paying industries to replace waning manufacturing or administrative roles. Now, on to the big question. Can cutting rates actually fix these problems, or are we just setting ourselves up for another speculative bubble? Since the global financial crisis in 2008, we've seen over a decade of easy money and near-zero interest rates. And yes, that helped stimulate the economy. But it also fueled widespread speculative behavior, especially in real estate and stocks. As soon as the money gets cheap again, what do you think is going to happen? Do you really expect banks and big financial institutions to suddenly invest their money wisely into new technology, infrastructure, or creating jobs? They're more likely to pour it into risky assets like tech stocks, crypto, or real estate bubbles, where quick returns have historically been more reliable than investing in productive sectors of the economy. During the pandemic, low rates juiced up asset prices like we've rarely seen. The S&P 500 nearly doubled from its March 2020 lows to the end of 2021. Real estate prices in cities like Miami and Austin skyrocketed. But with rate cuts returning, all we're doing is fostering another round of speculation rather than addressing the root problems: low-quality jobs, automation making certain industries obsolete, and the growing inequality between those benefiting from rising asset prices and those left behind. But wait, there's more. The economic picture also can't be seen in isolation within just U.S. borders. Global supply chains are nowhere near fully healed, 2 years after some of the pandemic's worst disruptions. The global economy is still extremely fragile, and events like the potential extended dockworker strikes that Goolsbee mentioned could cause substantial bottlenecks in key industries. Roughly 40% of the U.S.'s trans-Pacific goods flow through the West Coast, and strikes at ports throughout the West and Gulf coasts have already strained inventory levels. Retailers and manufacturers are already walking a tight line. With only about 2 weeks' worth of goods stockpiled at any given moment, a prolonged labor stoppage could have an outsized effect on industries far beyond just ocean freight. High inflation, rising geopolitical tensions, don't forget strained U.S.-China trade relations, gridlocked supply chains, and escalating debt crises in developing economies. All of these create unpredictable risks that interest rate cuts can't insulate. You might think that the strategy of rate reductions is meant to prevent a hard landing, but this path risks creating another potential economic pitfall: stagflation, where inflation rises while unemployment simultaneously edges higher. We're dangerously close to recreating the economic environment of the 1970s, when growth stagnated, inflation stayed high, and job access dried up, all while interest rate adjustments failed to address these concurrent issues. Cutting interest rates too early and too aggressively could see the economy stalled in the middle of some hybrid stagflation crisis. You'll be trapped with price levels rising and unemployment creeping up, unable to bring either under control due to the structural inefficiencies in the economy. This scenario becomes even scarier when we consider the broader macroeconomic shifts in global demand, supply chain fragility, and ongoing corporate cost-cutting measures. Essentially, the Fed could be walking a tightrope right now, balancing the need for economic growth against the possibility of a prolonged inflationary period without achieving the desired job market recovery. Let's take a moment to dig deeper into why Goolsbee and others at the Fed are so ready to push for interest rate cuts. Sure, the outward motive is laudable: prevent a spike in unemployment while making sure inflation doesn't wreak havoc. But is the Fed's rate-cutting plan really addressing the deeper economic issues, or simply treating the symptoms? Looking at historical data, aggressive rate cuts often lead to short-term boosts, but they may encourage long-term dislocations. For example, after the 2001 dot-com bubble burst, the Fed slashed rates so severely that it paved the way for reckless lending, eventually triggering the 2008 financial crisis. Similarly, the post-pandemic rate cuts caused another kind of market distortion, fueling everything from meme stock rallies to ridiculously overvalued tech IPOs. And as growth in speculative assets increases, we've seen an outcome where capital gets funneled into artificial financial booms instead of productive investment in infrastructure or equitable labor practices. Another major risk with cutting rates is that it makes borrowing cheaper, which, in theory, should lead to higher investment in productive sectors, right? Wrong. Historically, what actually happens is corporations access easy credit and use that money on stock buybacks or mergers and acquisitions, rather than investment in capital, research, or workforce development. Carlyle Group co-CEO Kuzong Lee famously called out this behavior in early 2023, warning of the dangerous consequences if cheap credit floods the market without real economic drivers for productivity. Let's zoom out and think of the timing of Goolsbee's statements. Fed policymakers reiterated that smaller quarter-point cuts could be expected at the last two meetings of the year, based on how the economy evolves. But are they preparing themselves for a scenario where the data will support their assumptions? You see, whenever the Fed signals an intention to cut rates, businesses and markets tend to respond preemptively to that expectation. Corporate CEOs might hold off on expansions or hiring until they can take advantage of lower borrowing costs, while financial markets might temporarily inflate based on the hope of cheaper credit. In other words, by saying rate cuts are coming, the Fed could inadvertently be setting the stage for the very economic slowdown they're trying to avoid. This kind of forward guidance dilemma isn't new. Fed Chair Jerome Powell admitted in previous years that the market often reacts more quickly to the Fed's words than its actual policies. And if Fed officials are too eager to forecast specific moves, investors and consumers become more speculative, gambling on when interest rates will shift and planning their spending and investment activities accordingly. This creates volatility across sectors that heavily depend on interest rates, housing, finance, and even tech. Is Goolsbee's statement, then, more of a reflection of where the Fed sees itself trapped, needing to cut rates because of where the economy is headed, rather than acting preemptively to steer us away from worse outcomes? One common mistake economists make is to analyze U.S. monetary policy in isolation. The reality is much more interconnected, and the cuts Goolsbee is advocating for could have global ramifications. It's important to remember that U.S. interest rates affect not only domestic markets but also impact global capital flows, emerging markets, and international trade dynamics. Firstly, rate cuts make U.S. financial assets less attractive to foreign investors. Treasury bond yields, for instance, would drop, forcing global investors to search for higher returns elsewhere. This means less international investment in the U.S. and more capital flowing into riskier markets like emerging economies. Consequently, this can destabilize weaker currencies like the Argentine peso or the Turkish lira, which may trigger another round of crisis in countries where economic instability is already a concern. Essentially, while the focus is domestic, the knock-on effects send ripples through global markets. Furthermore, the US dollar (USD) generally weakens in response to significant rate cuts. While this might sound like a good thing for American multinationals looking to increase exports by making their goods cheaper abroad, it can lead to retaliation in the form of depreciating foreign currencies and even accidental escalation into currency wars. The US-China trade situation alone symbolizes how easily economic moves morph into geopolitical tensions, and monetary policy tools like interest rates are often part of the chessboard. So, what does this all mean for Goolsbee's prioritization of the jobs market? Sure, it's reassuring to hear that the Fed is thinking about rising joblessness at 4.2%, but let's not kid ourselves. The quality of jobs matters as much as their quantity. The glaring red flag here is that rate cuts have rarely been enough to create truly good jobs. In fact, they often create an economy built on temporary employment booms. You see a rise in low-paying or outsourced positions, but no meaningful shift in wages or benefits. Consider the trend of growing gig economy employment. The rise of low-wage gig work, whether it's Uber drivers or DoorDash workers, has been one of the most prominent post-pandemic employment trends. While these jobs lower headline unemployment statistics, they offer little real job security. Lowering rates might provide short-term relief by increasing investment or consumption, but that bounce back often flows into industries that drive precarious labor and unstable employment contracts. What Goolsbee fails to make clear is that focusing on jobs, without considering their sustainability or well-being improvements for the worker, just perpetuates the uneven distribution of economic gains. CEOs celebrate these moves as long as the stock market rallies, while workers face stagnant wages. A study by the Economic Policy Institute highlighted in 2023 that real wage growth for the bottom 90% of U.S. workers has been virtually stagnant for decades. What's the use of more employment if that's the reality? More insidiously, inequality gets baked into the system as corporations continue to shift toward automation and the outsourcing of labor. Rate cuts ease the borrowing environment for these businesses, but are the benefits truly trickling down? When corporate balance sheets show enormous gains but the workforce faces wage suppression, you inevitably lead to a widening of inequality. And that, folks, is the real ticking time bomb Goolsbee and the Fed either fail to address or are knowingly ignoring. Goolsbee also touched on the strike issues, noting that U.S. dockworker strikes across both coasts could become a serious drag on the economy. The issue here isn't just labor unrest but also the fragility of globalized supply chains and how intertwined they've become with local labor markets. The United Auto Workers, UAW, strike of late 2023, for example, revealed just how precariously balanced the U.S. economy is between labor costs and corporate profits. As more sectors, from retail to manufacturing, experience similar unrest, the disruptions these strikes cause in supply chains will send ripple effects far beyond individual industries, affecting everything from automobile prices to holiday inventories. The Fed can't fix those disruptions through mere interest rate cuts. Strikes represent the workers pushing back against decades-long trends of wage stagnation despite rising productivity. The Chicago Fed president's comments about having only 2 weeks' worth of stockpiled goods, if strikes continue, should serve as a wake-up call. What happens when factories can't get critical auto parts or major retailers don't receive holiday inventories in time? Supply-side disruptions are real, and no amount of interest rate cuts will cushion those blows in the immediate term. Sure, lower borrowing costs might give businesses more liquidity to deal with surges in expenses once supply chains resume, but the damage during periods of disruption is lasting and structural. These risks show us the limits of monetary policy. Are we looking at a situation where the Fed is losing its primary tool, rate setting? When faced with the intricacies of global trade, income inequality, and widespread labor disputes? At this point, it's clear that Goolsbee's push to lower rates, by a lot, reflects only part of the solution. What the Fed and broader U.S. policymaking machine need is a multidimensional strategy that isn't overly reliant on interest rates alone. Here are a few more holistic approaches to consider. 1. Reinvest in job quality programs. Instead of just focusing on keeping unemployment low, there must be federal and state-level initiatives to bridge the gap between labor market demand and truly sustainable employment. This includes programs for retraining displaced workers, especially given forecasts of job automation, and raising the federal minimum wage, a long-deferred but urgently needed policy shift. 2. Greater fiscal monetary coordination. The effectiveness of monetary policy alone has its limits. What is needed now more than ever is an honest recalibration of fiscal policies. Stimulus investments in infrastructure that create long-term, high-quality jobs, as was attempted with the bipartisan infrastructure law, must continue. Governments need to match the Fed's actions with directed fiscal spending that shores up the most vulnerable parts of the economy. C. Addressing inflation via structural reforms rather than short-term fixes. While the Federal Reserve's interest rate policy remains the primary tool used to combat inflation, we must acknowledge that inflation is often driven by structural inefficiencies, not just increases in demand. For example, supply chain bottlenecks, labor shortages in key industries, and housing shortages all contribute to inflationary pressures. Instead of relying solely on monetary policy to fix inflation, policymakers need to pursue reforms aimed directly at the structural issues. 1. Supply chain resilience. Encouraging investment in domestic production, reducing dependencies on any single foreign market, like China for components, and increasing the diversification of trade routes and sources for critical goods are all ways to prevent future inflationary spikes when global supply chains are disrupted. 2. Labor market reform. Encouraging higher quality employment through policies like labor protections, wage increases, and job retraining programs will help strengthen the middle class while also addressing the mismatch between demand for high-skilled jobs and the availability of trained workers. 3. Housing supply. Housing prices, driven up by a lack of supply, remain a huge inflationary pressure in many cities. Easing zoning restrictions and promoting greater investment in affordable housing can help relieve these pressures. In other words, while short-term policy moves like cutting interest rates may provide temporary relief, they often just treat the symptoms. Real relief will come only once we make structural changes that strengthen the economy's ability to withstand future inflationary pressures. D. Industrial strategy for an automated future. As we move into an era of increased automation, AI, and robotics, the government must craft policies that will both protect workers and prepare them for the inevitable shifts in the economy. This includes large-scale investments in education and retraining, particularly for workers in industries most vulnerable to automation. Proactively managing the transition, instead of waiting for displaced workers to flood the labor market while the structural unemployment rate rises, will not only protect jobs but also strengthen productivity and innovation in the long run. Now, here's where things get really interesting for you, the average American who's trying to make sense of all this. You may have been puzzled by Goolsbee's urgent call for rapid rate cuts. At first glance, you might think interest rate reductions will make borrowing cheaper, right? Mortgages, credit cards, and student loans all become more manageable. So what's the harm? The problem is that such cuts may temporarily help individual borrowers, but they won't fix the structural issues plaguing the economy. There's a high chance that the benefits of these policies will go primarily to large corporations and financial institutions, not to average consumers. Here's why you should be concerned. Risk of new economic bubbles. History tells us that when interest rates are too low for too long, speculative bubbles tend to form. We saw this during the 2000s housing bubble, and following the post-pandemic rate slashes, speculative bets in startups, cryptocurrency, and meme stocks grew to unsustainable levels. If Goolsbee's proposed deeper rate cuts come into play, there's a real risk we could see bubbles inflating again, this time with potentially even more damaging consequences. While these asset bubbles may initially seem like a good thing for some investors and CEOs, they inevitably lead to a crash when reality hits. And, as we've seen, it's the ordinary worker who pays the price through layoffs, reduced purchasing power, and even a diminished social safety net as governments scramble to rectify the aftermath. B. Inflation may not stay low for long. Lowering interest rates can threaten the progress we've made on taming inflation. Let's not pretend inflation has disappeared. It's just hovering around the Fed's 2% target. But with food prices, housing, energy costs, and services far from stable for much of the middle and working classes, even a slight uptick in inflation can be highly problematic. For those of you who are managing households, living on a fixed income, or are dependent on the rising costs of services, inflation won't be fixed simply because the Fed cuts rates. Supply-side shocks, labor market rigidity, and structural imbalances in the economy mean that inflation is likely to rear its ugly head again, and soon. Lower interest rates, combined with fiscal spending focused on keeping people employed, can, ironically, reignite inflation where it's hardest to manage, the prices of food, rent, and other essentials which don't reflect broader cuts in other goods and services. C. Stagflation threat, low growth with persistent inflation. We touched on this earlier, but there's a real and growing risk of stagflation. A toxic combination of low economic growth alongside persistent inflation. This is the worst of both worlds. Sluggish job growth coupled with price increases makes it virtually impossible for working-class Americans to improve their living standards. If stagflation takes hold, even the Fed slashing rates by a lot won't bring relief. It will only prolong economic pain. You might be asking yourself, if cutting rates is potentially dangerous, what should be done instead? It's a good question because the answer reveals just how limited our current economic toolbox is, and it forces us to rethink the fundamentals of economic growth and stability. While monetary policy is still a powerful lever, it is only one piece of the puzzle. Here are a few alternatives to interest rate cuts that could potentially stabilize the economy while addressing deeper-rooted problems. 1. Targeted fiscal policy. Fiscal policy, done right, can be far more efficient than relying solely on interest rates changes. This means increased government expenditure in areas where it'll have the most long-term benefit, like infrastructure, education, and green energy. The CHIPS Act, passed in 2022, represents a step in the right direction by investing heavily in domestic semiconductor manufacturing, an industry of essential strategic importance. 2. Direct support for workers. Instead of manipulating interest rates to help businesses maintain profitability, the government could provide direct support to workers through wage subsidies, job training, and strong unemployment benefits. This approach would stabilize the labor market far more effectively than hoping cheaper borrowing spurs corporate hiring. 3. Promote innovation through tax policy. Lower rates may prompt investment, but smart tax policy incentivizes investment in the right places. By offering tax credits for companies that invest in tech, clean energy, and productivity-enhancing capital, rather than just stock buybacks, the economy can grow in a more sustainable fashion. This ensures that capital investment, employment, and productivity rise together, making inflationary spikes less likely. For reign in corporate consolidation, one of the reasons wages have stagnated is due to monopolistic tendencies across key industries. Whether it's retail, tech, or pharmaceuticals, consolidation has allowed companies to dominate markets and suppress wages. Strengthening antitrust laws and regulatory oversight would help foster competition, innovation, and wage growth, more than just low interest rates ever could. 5. Address supply chains and housing directly. The government should take action to unclog supply chains and boost housing construction. Investment in infrastructure aimed at improving logistics or partnerships with the private sector to build affordable housing can solve bottlenecks more effectively and reduce inflationary pressures stemming from those specific sectors. For the more professional side of my audience, traders, portfolio managers, economists, and financial analysts, where should you be focusing your attention right now with these mixed economic signals? Goolsbee's statements cue up a volatile period for monetary policy changes, labor market developments, and inflation trends. Here's what should be on your radar. 1. Fed meeting minutes and upcoming rate decisions. Pay close attention to Fed minutes and speeches from members like Goolsbee, Powell, and others. Markets tend to interpret those subtleties, and it could foreshadow moves to adjust portfolios, especially in more interest rate-sensitive sectors like bonds, real estate, and financials. 2. Jobs and labor reports. Watch for key employment data, especially wages and participation rates. The September jobs report showed that wage growth year-over-year slowed to 4.2% in 2023, signaling possible broader weakness in the labor market. Any deviation from previous trends could indicate further policy shifts. Look beyond headline job numbers and pay attention specifically to job quality, sectoral allocation, and regional disparities. 3. Corporate earnings reports. With a flurry of earnings calls coming up, particularly for companies in consumer goods, industrials, and tech, it's critical to gauge real corporate sentiment on economic headwinds. Forward guidance will reveal how companies are coping with a still inflationary environment, higher borrowing costs, and consumer sensitivity. Those reactive cost-saving measures from companies, especially layoffs, could preempt Fed actions. For U.S. dollar and global markets. If the Fed starts aggressively cutting rates compared to other central banks, like the European Central Bank or Bank of England, this will weaken the dollar, potentially affecting export-heavy companies and commodities markets. Emerging markets, in particular, could see capital flows react disruptively, which in turn affects global supply chains and production for U.S.-based firms. 5. Industrial strikes and labor movements. Labor unrest is likely to increase as income inequality pressures rise alongside corporate profit margins. For investors, retail, shipping, and auto sectors will be particularly vulnerable to labor disputes. Keep an eye on policy moves around labor laws, as a prolonged period of strikes and labor disruptions could create costly supply problems across industries. In wrapping up this dive into Goolsbee's call for interest rate cuts, we must confront a sobering truth. The ongoing struggles of the U.S. economy highlight structural weaknesses that cannot be fixed through monetary policy alone. While Fed officials like Goolsbee may advocate for steep rate cuts to prevent rising unemployment and stimulate growth, this approach could present significant risks. The long-term health of the economy requires a more nuanced and multifaceted approach. Simply cutting rates risks inflating financial bubbles, reigniting inflationary pressures in crucial sectors like housing and food, and ultimately leading to higher inequality and stagflation. Without addressing the underlying issues, such as structural inefficiencies in the labor market, globalization's fragility, and the automation revolution, any future rate cuts will only act as a temporary band-aid, not a real solution. America has reached a turning point where relying on one tool, interest rates, is no longer effective. It's like treating symptoms without diagnosing the root cause of an illness. Monetary policy has its place, but right now, the economy needs a broad-based reform package that tackles the following key areas. 1. Labor market restructuring. The U.S. must invest in active labor market programs to improve workforce quality, retraining workers for high-skill industries, giving workers greater protections and benefits, pushing for higher real wages, and providing incentives for companies to invest in human capital will be far more sustained drivers of growth than lowering interest rates. In industries where automation will displace jobs, we need transition programs that help workers move into new sectors with fewer disruptions, a concept many European economies have implemented with greater success than the US. 2. Supply chain strengthening. The pandemic, followed by labor unrest, has made the fragility of global supply chains apparent. Building supply chain resilience through diversification, domestic manufacturing, and smarter logistics will help curb inflationary pressure, ensure pricing stability, and safeguard critical industries against future disruptions, whether from strikes, geopolitical risks, or natural disasters. 3. Fiscal policy coherence. A more targeted fiscal approach should aim to bridge gaps that monetary tools cannot reach. Unlike monetary policy, which often has indirect effects, fiscal programs can more directly resolve problems like infrastructure gaps, technological investment shortfalls, and labor force misalignments. Government infrastructure spending, like the investments seen in the CHIPS Act or Biden's Inflation Reduction Act, needs to be ramped up and paired with tax incentives for industries investing in sustainable growth, clean energy, and technologies of the future such as artificial intelligence, clean energy, and biotechnology. 4. Quelling corporate concentration. The imbalance caused by monopolistic and oligopolistic behavior in key industries, whether it's big tech, pharmaceuticals, or agriculture, needs to be regulated more effectively through antitrust laws and competition policy reforms. This will not only help in lowering prices for consumers, but also provide smaller companies with more competitive leverage, paving the way for innovation and job growth. 5. Tackling affordable housing. One of the most persistent drivers of inflation has been housing costs. Monetary policy affects mortgage rates but does little to address the underlying issue. Not enough homes are being built. Zoning reform, affordable housing projects, and private development incentives must be considered to lower housing costs in major metropolitan areas where affordability has become a crisis. Expanding access to housing will not only help temper inflation but will strengthen the social safety net and empower lower-income families who currently bear the brunt of these high costs. Goolsbee's vision of cutting rates by a lot within the next 12 months could easily backfire. While he's confident that inflation is under control and that the job market needs preemptive rescue measures, pushing for aggressive rate cuts echoes past economic misjudgments. Let's look at some examples of why rushing to cut rates is fraught with danger. 1. The 2001 dot-com bubble aftermath. When the dot-com bubble burst, the Fed slashed rates in an attempt to stimulate growth. While this worked temporarily, it laid the groundwork for excessive risk-taking, which ultimately led to the 2008 financial crisis. The economy wasn't ready for the profligate credit that followed and eventually fell off a cliff, plunging millions into unemployment and creating a recession so deep that it took years to recover. 2. The post-pandemic speculative frenzy. After COVID-19, rate cuts fueled a bull market in speculative assets like cryptocurrencies and meme stocks. Popular investment platforms experienced user surges, with millions of retail investors pouring money into speculative trades based on viral social media campaigns, not fundamentals. Companies like GameStop and AMC saw astronomical stock price rises, only for much of that paper wealth to evaporate once reality set in. The excessive liquidity created by low rates could lead to another speculative mania, putting ordinary investors at risk while allowing professionals to profit from speculation. 3. The stagflation of the 1970s. Goolsbee's plan to lower interest rates aggressively raises fears of a return to stagflation, the dreaded combination of high inflation and stagnant economic growth. In the 1970s, price controls, combined with poorly executed monetary policy, led to runaway inflation that wasn't fully tamed until the drastic rate hikes under Paul Volcker in the 1980s. If inflationary pressures in today's housing, energy, and food sectors aren't properly addressed through structural reforms, interest rate cuts would be trying to solve the wrong problem. So where do we go from here? The current economic challenges faced by the U.S. demand much more than simple rate manipulation. Goolsbee's call for significant interest rate cuts is a response to very real problems. But the economic toolkit he is relying on is incomplete and may prove dangerously short-sighted. To successfully navigate this turbulent period, we should build a comprehensive economic policy platform that balances both short-term interventions and long-term investments. Ultimately, the solution to our economic woes doesn't lie in the Fed's rate-setting abilities, but in a highly coordinated approach involving fiscal reforms, labor market investments, corporate regulation, housing initiatives, and smart tax incentives. Policymakers and the public must demand more from leadership than just band-aid solutions to systemic issues. This isn't merely about stopping inflation or preventing a temporary rise in unemployment. We need an economy that works for everyone. In doing so, systemic inequality can be reduced, inflation can become more manageable and predictable, and most importantly, the U.S. can create durable, meaningful jobs that foster long-term growth and opportunity for future generations. In conclusion, Austan Goolsbee's push for aggressive interest rate cuts represents the Fed's attempt to manage an economy at a crossroads. But it's a risky move. The structural problems within the U.S. labor market, the global supply chain disruptions, persistent inflationary pressures in critical sectors, and the risks of further speculative bubbles all call for much deeper solutions. By looking at the big picture, it becomes evident that lowering rates will not provide a sustainable path forward. A holistic approach, one that goes well beyond the limited effects of monetary policy, is necessary. This means reinvesting in the workforce, bolstering supply chains, ensuring fair competition in major industries, addressing the housing crisis, and above all, creating a smart fiscal policy designed for the long term. As individuals and professionals, we must brace ourselves for an economy that will continue to face uncertainty. But with the right decisions, made by considering the lessons of history and focusing on durable improvements, we can foster a resilient, equitable, and strong economy for everyone. Short-term fixes have long-term consequences, and we simply cannot afford another economic misstep. It is time for policymakers to look beyond immediate gains and build toward a genuinely inclusive economic recovery. Thank you as always for watching the channel and staying engaged with the latest in financial news. Don't forget to subscribe, hit the bell button for notifications, and leave your comments below. What do you think about Goolsbee's proposal for lower rates? Do you think the Fed should act more cautiously or push rates down to stimulate growth? We'd love to hear from you. Until next time, stay informed, take care, and stay savvy about your money.